Okay, hello everyone, and welcome to the Viking Wealth Show and Multifamily Freedom webcast. I'm your host, Ravi Gupta. Last week, we spoke to Greg Dickerson about the general market, and today we're going to draw down our focus to multifamily real estate. In that light, I'm pleased to introduce to you all Rob Beardsley. Rob is a principal and founder of Lone Star Capital. Rob oversees acquisitions and capital markets for the firm and has acquired over 100 million of multifamily real estate. He's evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, which is extremely impressive. The book is called The Definitive Guide to Underwriting Multifamily Acquisitions. He has written over 50 articles about underwriting, deal structures, and capital markets, and hosts the Capital Spotlight podcast, which is focused on interviewing institutional investors. Welcome, Rob.
Thanks for having me.
Absolutely. I feel like you're so accomplished at such a young age. So I feel like my first question, especially those with kids, is what kind of special sauce do you put on your food? What kind of drugs do you take to do what you've done at such a tender young age?
Yeah, we could definitely talk about that formula. I think there's definitely elements of nature and nurture involved. I can't take full credit. My parents did a fantastic job raising my sister and myself. They were super supportive of any ambitions that we had and just cultivating that sort of work ethic. Everything is, obviously working hard is important in everything you do. So that was something that was kind of in part just my natural thing. I was always wanting to work hard. I didn't really like play. I liked work. And then building structure around that to actually, okay, you like to work, that's good, but now let's focus it on productive stuff. So,
Okay. So
with that
no drugs
mindset,
per se.
no drugs per se.
Okay. All right. Just want to clear that up front.
Books are kind of drugs.
Books. Okay. All right. We got it. So yeah. So I mean, in that light, just maybe a little bit of background about yourself. Kind of where you grew up, how you came to be where you are right now.
Yeah, I grew up in Silicon Valley, and my parents ran a residential brokerage firm back in Silicon Valley, and they were really busy with their business, and they were kind of stuck in that middle class rut, not really accumulating wealth, working hard for their income. And all growing up, we were surrounded by these super rich tech entrepreneurs, whether they worked in a startup or they're in venture capital or they worked at one of the major tech companies. There's all this tech wealth around us. And my parents pushed me, said, this is where you want to go. Real estate's a boring game. Go into tech. That's where you're going to make the big bucks. And so that was kind of my path. I went to school for computer science. I thought I would get into consulting or maybe, be a part of a startup at some point. But the real estate bug got me, and I started just obsessing over investing. I was always a fan of delayed gratification, working hard, planting seeds for tomorrow, and that kind of mindsets, which really fits nicely with investing, both growing a business centered around investment, as well as just actually investing your own money kind of as your personal investment strategy. So circling back to real estate, my family had never done anything in multifamily. Everything was in the single family side as far as buying and selling homes for their clients, development, fix and flip, construction. So when I came to my family and said, hey, multifamily is the thing, there was a lot of pushback, and it was just new to them. So I had the benefit of not having any experience, and I could just jump into new things with open eyes and no preconceived notions. And that's what allowed me to kind of quickly learn, get involved in the business, network, just be humble and try to learn as much as possible through people and through my own homework. And, from there, that's how I was able to meet my business partner. And then we formed Lone Star 4 years ago. And, fast forward to today, Lone Star has acquired over 300 million in multifamily assets in Texas. And we've launched our own in-house property management firm. And we're excited about the future.
Well, that's amazing. Well, it's a great story, and thanks for sharing that with us. Well, let's get down to it. Now, we had a podcast last week where we just spoke about the market in general, but really want to get your thoughts on the current market, especially as it relates to multifamily real estate. We've got issues with inflation, supply chain issues, interest rates are on the rise, talks of quantitative tightening, but then at the same time, there's tremendous demand for apartments. There's record rent growth. There's tremendous net migration to certain areas. So if you could just kind of give us your thoughts on the market as a whole, are you bullish on the market? Where are you thinking about buying? If so, that type of thing.
Yeah, there's some, like you said, there's some very strong, interesting pressures in the market, both on the positive and the negative side. For example, as we've all seen lately, there's been a crazy, feels like a regime change as far as interest rates go, right? They just went lower and lower and lower. And now everyone's saying interest rates are going to the moon, and the forward curve is up, the 10 years up. Fed just raised rates last week. So in general, a negative pressure for real estate because uh, interest rates going up puts upward pressure on cap rates. They don't move one to one, but there's an upward pressure there. And that can be combated with something else that you mentioned, which is just demand on the capital side for hard assets, for cash flowing real estate. And that can overwhelm even rising interest rates, right? You could actually see, I'm not predicting this, but you could actually see cap rates go down even while interest rates are going up if there's just enough money around the world all chasing these assets. And we've seen that for the last 5 years, at least, with global capital flows continuing to favor multifamily. And that's been the push for lower and lower cap rates. And lowering interest rates have helped as well. But we've had high interest rates like we pretty much do today back in 2018. And prices were the same. I mean, it didn't, or prices are higher now. So there's so many factors at play. So the capital demand is big. The interest rates rising are big. Inflation is the big one, and inflation can be viewed as both a positive and a negative. We're seeing record rent growth, and inflation has to do with that for sure, of course, right? So, and that's if you're a landlord, that's beneficial. If you're a renter or buying groceries or gas, that's not good. So even though inflation impacts the expense side of our P&L, it's overwhelmingly positive on the income side. Just to make a simple example, even if rents are going up the same as your expenses, rents are typically double your expenses, right? A 50% expense ratio. So you're actually in the end going to net a positive benefit. So inflationary environment is positive for real estate, keeping all else equal. If inflation causes rates to go up and cap rates to go up and all that stuff, then that can be bad. But what you're seeing is people are buying today based on the assumption of growth in the future because they're seeing it happen now. And there's all these compelling trends that you pointed out as far as migration and population growth, job growth. So when people are willing to buy today on the assumption of future growth, that means they're willing to pay a lower cap rate today. So while people think, okay, well, rising interest rates and inflation, you would think that cap rates have to go up too, but cap rates aren't bond yields. They don't have to accommodate rising inflation. They can actually go down because people are paying for embedded growth. So all that's to say, I'm not trying to predict the future, and we don't make investment decisions based on all these crazy thoughts that we have. We try to stick to our conservative fundamentals and underwrite the same way, even if we do think that, times might be changing and whatnot. We don't try to predict the future. We try to invest consistently and conservatively in the markets that we know. We're not just going to jump to new hot markets because of XYZ trend. That's not a bad thing. That's just our style. Our style is we like to stick to the markets that we're in and continue with our philosophy.
Okay. Thanks for that update there. And I'm in complete agreement. And I'll give you a quick example of something that we've seen recently. We're looking at some new construction deals, and the developer was mentioning that he had a particular deal that was valued at 50 million initially, and this was several years ago, but because of the supply chain issues and inflation and costs have risen over time, the cost of building the complex went from something like 35 million to almost 45 million. But when they repriced the property and they reappraised it, it went up to like 70 million. So you're seeing growth on that end as well, and that sort of counterbalances the cost rising of different types of supplies. And I think what you're mentioning, as the cap rates do drop, you really have to focus on that growth. I mean, if you know the market's going to grow, to the best of your ability, that's where those yields come in. It's predicting that future growth to a certain extent. And that brings us, I think, to the next question is, when you're looking at markets, we've got the whole U.S. here in front of us. Like, how do you narrow down your search from any particular market to specific ones? How do you do that?
So for us personally, like I mentioned, we have very deliberately picked our markets, which, we're in Texas and mainly just Houston and Dallas, Fort Worth. And there's a lot of good reasons why those markets are great. A lot of people know those reasons. It's not a secret. You've got landlord friendly state, business friendly state, no state income tax, population growth, job growth, always at the top of the charts. And there's a lot of inventory of the type of product that we like, which is good because we don't want to sit around and wait for one deal a month to come across our desk. We need lots of deal flow, so that way we can filter through and do the deals that we really like. So that's just kind of what we do and who we are. But if I were starting fresh and I had the whole US in front of me and I were to start narrowing things down kind of from scratch, then I would, a few things that I would consider are, and again, this is just me. I don't like to chase the super flashy growth because I just find the pricing to be very challenging. But there's pros and cons to every market. And one of the things to definitely to consider is investor appetite. You might have an idea about some amazing market that no one has ever heard of. It's a small market and it's not very attractive from an investor perspective. Going in that market could be very dangerous and you might be setting yourself up for a difficult road because convincing investors to follow you is going to be so tough. And on the flip side, if you pick the name brand markets like a Phoenix, a Denver, a Dallas, a Tampa, you're going to have investors who just automatically are going to be excited, but the numbers are going to be a lot harder to make sense of. There's a lot more competition and the things are tighter. So it's just a balance. And for us, we kind of like to be in the middle. We don't want to be where it's too crazy hot. But we're learning. Maybe eventually we'll get there. But at the same time, we don't want to put ourselves in a situation where investors are scratching their heads and they don't understand why in the world we would be doing a certain deal and why they should invest. So that's the mindset that I would approach kind of the US from a fresh point of view.
Okay. So specifically, you're talking about population, job growth, a submarket, the demand for apartment complexes, the diversity of apartment complexes too, right? Because you want a lot of buying and selling to happen in that particular market there. That submarket. You don't want to go to a place where maybe there's like a few assets that don't transact very frequently. You're talking about rent growth as well, and the path of progress is something else. We always look at. We're kind of, a lot of us are focused on the Sun Belt. Texas being one of those places. I mean, do you look outside the Sun Belt, or what are your thoughts of going outside the Sun Belt now? Just for those that are listening, the Sun Belt sort of like a smile at the bottom of the U.S. map there, including Florida, Georgia, Texas, Arizona, those states, and there's just, as we all know, tons of migration in that area. That's why there's such a demand. But I mean, there are potential diamonds in the rough outside. So, like if somebody is looking for something like that, how would you advise them looking outside the Sun Belt?
Yeah, I think you can make money in any market. So it's something that I say, which isn't entirely true, but it's kind of this general idea that I do believe in, is it's less important about which market you pick and more important that you pick a market, because so many people don't pick a market. So many people just kind of bounce around from market to market. They chase the shiny object and they don't drill down and become experts in one area, and they don't build relationships and a reputation in one area. It's really hard to do it everywhere, right? And taking that focused approach is what has allowed us to be successful. And I think that is more powerful than trying to find the best deal everywhere. So even if you pick a market that, for whatever reason, you might pick it because you're local or because it's closer, or you just have some sort of thesis around it, may not be the best market in the world, but the fact that you picked it and you make it the best market for you, that's what's most important.
Yeah, I think that's a great tip. A lot of people are jumping from market to market, chasing that shiny object, and uh, picking your own backyard as a first place to invest is really always a good option. I mean, we live in here in Northern Virginia, and there are not a lot of deals in Northern Virginia. There's some in DC, and it's not one of the top markets, but certainly if I were starting, it would be the place I would look at first, because then you could talk to the brokers, you could look at the asset often. You're right there, so that's super important. Now, kind of all that being said, and stepping back, your thoughts are that there are good deals to be had in this economy. Are you, and if you find that particular market that you like, are you currently on the path of buying more? Do you predict that for your company the next several months?
Yeah, I sure hope so. I think like many of us, we're always ambitious. We're entrepreneurs, we're optimists, we're looking to grow. So, I think there's a justification to be buying at all times, right? If the market is down, well, it's a great time to buy. If the market is hot, it's a great time to buy. And you just have to position yourself a bit differently based on the market. So something that we're seeing right now is it's difficult to do deals at less than 80% leverage when most people are also doing it at 80% leverage. Investors have a difficult time assessing risk, right? It's easier for investors to look at deals and say, well, here's this return number and this return number. And they'll often just pick the deal with the higher return, but that's often the wrong choice. And it requires risk is the hardest part about investing, because no number can define risk. There's so many different elements to it, and it's subjective. So the reason why I bring it up is because when the market's hot like it is right now, that's when there's the most risk, because if the market cools down, that's when you're going to see things that can cause problems. I think all in all, the multifamily market is extremely healthy relative to other periods in history where we've been at a point like this where the market's really hot. If you look at the dot-com bubble and the 2008 financial crisis and the S&L crisis in the 90s and going back further, real estate was always overbuilt and lenders always lent too much. That's not the case. We're not overbuilt here in multifamily, and lenders have been really conservative this cycle. Lenders are keeping everything back. And I think that's why multifamily is so healthy right now. So we're not going to, if we do have a cool down, it's not going to be a big crash. So with that being said, if you are over levered or have a certain deal structure that's riskier, a small crash could wipe you out. And that's the most important thing to avoid, is being wiped out. So positioning yourself and adjusting to the market, still buying assets, because we always have to invest, right? If you were a rich person right now and you had $100 million, you couldn't sit with $100 million in the bank. You couldn't sleep at night, because with 10%, 15% inflation, you're losing a ton of money. You have to find a place to invest. So it's not an excuse to say, well, I'm not investing. You just have to position yourself based on what the market is doing.
Okay, and that's a perfect segue to my next question. Is you discuss risks. One of them you mentioned is you'd be wiped out if you over levered yourself. I mean, if you could just give us kind of maybe some more detail on that, and then also red flags in looking at new markets or apartment complexes.
So as far as risks and things like that, or things that we're doing, something that we're seeing right now, as everyone else is the craziness with floating rate debt, because the market is projecting rates to rise so much on the short end of the curve. That's really throwing things off. Rate caps, so interest rate caps, which are a hedge product that borrowers are required to purchase when they do a floating rate loan. Those are crazy out of control. The prices are nuts. And if you believe in the path of interest rates where things are being projected to go, it's a meaningful shift to where we could have over 5% interest rates in a couple of years, and that's going to crush cash flow. So, what we're really doing is, IRR is really important to us, but we're really stressing cash flow in our deals. because it's cash flow is both a fundamental reason to invest, but it's also a risk mitigant. If you have cash flow, it'll protect you in a downside scenario, right? If you're not living off of your cash flow, then in a bad situation, you might not be able to live at all. So that's why right now we're stressing the importance of cash flow and stressing it in the future because because of the predictions of rates being higher in the future. Personally, I don't believe that the market is going to, well, the Fed specifically is going to raise rates as much as the market is projecting, but that doesn't mean I'm not going to protect and prepare for it. So again, I'm not trying to have my personal thoughts influence our investment philosophy. So that's interest rates, kind of the big risk. So the focus on cash flow, it's not easy today. And then another tough way to go is to use less leverage. And we're now looking at, we used to always want to get as much debt as we could, right? Because we want to get the best returns, and debt is cheap. So we want to take as much of it as possible. But now we're looking at different structures and lower leverage points at 70%, 75%, rather than just trying to shoot for bridge loans at 80. So that's something new for us. And I think it could be very successful for us in this time.
Are you finding deals that work with that type of leverage? And
I mean, it's always hard to find deals,
yeah.
But I guess the short answer is yes, but I'm not trying to make it sound easy.
Yeah. Okay. All right. Like a diamond in the rough there that you're looking for.
Yeah. And I think also there's an element, which I'm sure you guys have experienced as well, is a re-educating of your investor base and getting them on board with, hey, this is lower risk, so the returns might be a little bit lower than what we're used to, but here's all the reasons why we think this is the best move. It's not an easy thing to do, but I think that is it's worthwhile.
Okay, great. And just to expand on that a little bit, and I completely agree with you in that if you are over levered, there's a risk, because if you do have floating rate debt, which almost all of us do at this point, if you're acquiring new properties, the rate starts increasing, your cash flow obviously will decrease. And if you're banking on, just the small amount of cash flow you're getting, and that rate goes up, you're gonna hit zero quickly. Now, the way to mitigate that is to have cash reserves. And when you are investing in a deal and your sponsor is holding cash in reserve, some people are like, oh, well, why are they doing that? What is the point of holding that cash in reserve? Because it's, extra cash that's not going into the deal. I'm not going to potentially make as much, but it really makes a difference. If you are using higher leverage, you have that extra cash. If things were to go south, you can use that. So that's one way to mitigate that issue.
Yeah, we've been pushing our reserve number up. We have been typically doing about 1.5 months of operating expenses and debt service for our cash reserve in the bank. And we've been pushing that to 2 months. It's not a huge move, but just pushing it when we feel appropriate to 2 months worth of operating expenses and debt service.
Excellent. And then, you wrote the book on underwriting. So anything else, any other kind of tips or pearls that you can offer us on underwriting and risk mitigation?
Yeah, I didn't really touch on red flags. I feel like red flags are a popular topic lately, so it's maybe a bit cliche. But as far as underwriting, I think the really interesting thing that no one is ever going to know is exit cap rates, right? They're out in the future, they're speculative, and they're controlled by the interest rates, by global capital flows, by recent, property performance. So with exit cap rates, it's the same philosophy. We're not trying to predict. We're trying to stick to our conservative fundamentals. So today, even if I think that, let's say, cap rates are going to go lower, right? I'm not saying I necessarily do, but if I did, I wouldn't bake that into my underwriting and project a lower cap rate. I still need to stick to my fundamentals and use a higher exit cap rate than what the current market is at today. And which is not that hard to do because the market today is so low, right? We're seeing, depending on what you're buying, market cap rates of around, low threes to low fours. I'm sure there's other places where it's even lower than that. So if you've got, a market cap rate of 375, it's conservative, and our philosophy to then take that 375 and push that to 475 in many cases. And so a couple of years ago, a 4.75% exit cap rate sounded very aggressive to us, but now it sounds reasonable. And I think that's kind of the decision that you have to make if you want to be a player in the game. If you want to sit on the sidelines and say, well, there's very smart people out there that think cap rates are going to go to 8% or something like that. And the reality is, if you underwrite deals with that assumption, every deal will look awful and you will never buy any deals. So it's just really a question of, do you want to be an investor? Do you want to buy deals, or do you want to be a theoretical investor on the sidelines? So that's a new element of, take it as whether you want to view that as being conservative or aggressive. Everyone's going to have their own opinion.
So as an investor, if you're looking at a particular deal that you may be interested in investing in, there's something called the sensitivity analysis that gives investors the idea of what would happen if cap rates went up or down. Can you talk a little bit about that, what that is and how it can help?
Yeah, it can definitely help. I think it helps people to kind of quickly, like you said, sensitize the deal and get more comfortable with the various outcomes. We want to know that, okay, fine, the projected returns are here, but what's the dispersion of possible outcomes? And with sensitivity analysis, it's great to see, okay, here's the base case scenario, but if cap rates move up by this amount, or if they move down by this amount, what's the variability of the outcome? And so the reality is there's certain metrics or inputs that heavily weigh on the outcome of the projections, and then some that don't really mean that much. For example, moving the exit cap rate a little bit up or down will really impact the outcome of the deal in most cases. But if you have a situation where you go over budget on your capex by a few $100,000, it's not going to really move the deal in the same way. So focusing on the levers that really move the deal is how you can really most effectively spend your time. You don't want to be spending all your time trying to be precisely accurate on these things that aren't really that meaningful to the numbers. So focusing on the big picture stuff, which are pro forma rents, the expenses, and then the exit cap rate. Maybe I could replace expenses with growth, but growth is pretty standard. I don't think, at least I'm not seeing people really use crazy growth numbers. I think people are being pretty reasonable, right? 5 years ago, I would have thought that 3% rent growth was aggressive, but now 3% rent growth, it's happening every few months. So that would be kind of the boxes I would check.
Okay. And something to keep in mind too for you investors is that cap rates, the projections are, as Rob mentioned, pretty subjective. Like you could, a sponsor could say, hey, well, the cap rate will only go up by 30 basis points or so. And their projection is based on that. But if there's a sensitivity analysis in that investor memorandum, which there always should be, you can figure out what the returns would be if that cap rate were to go up. So you can say, hey, look, the way I invest, I predict 10 basis points per year increase, which is sort of kind of a rule of thumb that you could use. And in 5 years, it's going to go up 50 basis points. Well, this person's only, projecting 30, but here's a sensitivity analysis. And I'm looking at the 50 number, and, maybe this deal's a little tight for me. I'm not going to invest in it. So that's a tool that you all can use to figure out if you're interested in a deal or not based on your own criteria. Awesome. Well, thanks, Rob. And then let's move on to the next topic is resources. So what resources do you use to gather and analyze all data and market trends?
We have experience with CoStar and Yardi. We're currently using just Yardi. We've used, and so those are obviously paid data sources, which are great. For free resources, we actually do use Justice Map every day. Justice Map is a great resource. Just get quick info on incomes. That's the focus. You can see incomes on a pretty granular level. And, obviously to us and many investors, median household income is really important.
So can you describe that? I haven't heard of Justice Map before. So how does that work exactly?
Yeah, it's just justicemap.org, and it's
Mhm.
a free resource, and you just type in an address, and then you can get uh, income data for the census tract that address is in. And then you can also use an advanced feature to zoom in on the block, which supposedly is less accurate data, but it lets you get very precise, much more precise than your typical kind of 1 to 3 mile radius data for income and things like that.
Excellent. And then CoStar and Yardi, they're paid subscriptions. Um, there's a lot of data that uh, those folks collect, and you can get that from brokers as well, or your property management team. A lot of them have access to those, uh, and you can easily ask them for CoStar or Yardi data if you'd like. What else? What else do you use? Anything else that we should know about?
Trying to think. I mean, one thing that we do that's really cool is we collect all of our acquisitions pipeline data into one Excel spreadsheet of, so each row is a deal that's fully underwritten with it, data on the cap rate, on the strike price from the broker, the price that we like it at, our NOI, the CapEx budget. So we, really have a lot of great data. And then we just compile this data on a quarterly basis. So we'll have, let's say we underwrote 100 deals in the quarter, then we'll have 100 data point, 100 rows of data points. And that really lets us have a great insight into our pipeline. We know, okay, well, we underwrote 100 deals in this market, and the average cap rate in the last quarter was 3.3, and our average yield on cost was, I don't know, 5.2. And so, you kind of start seeing the market and you can understand what's going on. And that way you're not just kind of closing your eyes and saying, I want a 20% IRR, because that may just not exist in the market, or at least the way that we underwrite. And so one thing is just consistency, right? Consistency in the way you calculate things, and consistency in the way that you underwrite, and then keeping track of all that data. So that way you really can identify a great deal when it comes up, because you have all this data to support and say, well, here's all the deals, and this one's here. It's better than all of them. And then gives you the confidence to jump. So, obviously that's just done in simple Excel, but it's, I think one of the most valuable things that we do.
Excellent. And there's another tool called Red IQ. It's similar in that you can actually input your own data into that database for the assets that you own and assets that you're underwriting. And just as you said, Rob, you can analyze assets using that software as well. It's another paid subscription, but another way to do what you're doing on Excel. Excellent. And the final question for you before we open it up to questions from the audience is, how do you leverage your team to better understand market dynamics? Like who tours the assets? How do you look at comps? All that kind of stuff.
Yeah, good. So because we have our own property management business that we started last year, it's based in Houston. We have a great local team there that operates the portfolio, but we can also leverage them to help on the acquisition side, because who better to inform us as far as our assumptions and then actually be boots on the ground and tour inspections and all that than our operations team. So we're always working hard to try to connect acquisitions and operations, because too often they don't talk to each other enough and they're off doing different things, and that causes confusion, miscommunication, and also delays. So we're trying to speed up the processes, increase the communication flow, so that way when our asset management team is learning stuff, that knowledge feeds to the acquisitions team. And when the acquisitions team is out there underwriting a bunch of deals and looking at all these financials, they can inform what's, to the operations team about that information as well. So that's been something very important to me. We have an awesome team here in New York. We have an awesome team in Houston, and that allows us to move quickly as far as chasing after new opportunities, quickly doing tours. One of us in New York can jump down, get on a plane and do the rent comps, shop all the properties. There's so much you can do remotely as well. I mean, our our team here will call comps and, hey, I'm interested in a 2-bedroom. What's the extra charge for washer and dryer? And, kind of get us, you need to dig further. It's not enough garbage in, garbage out. So you have to have good information to have good output.
Great. Do you find that there's tremendous benefit in being vertically integrated with your own property management team?
I think so. I think it's totally doable without it. You could go your whole life without vertically integrating. So it's not a must do by any means. For us, it made sense because it goes back to that focus, right? We're focused as far as our acquisitions. And if we own property all across the country, unless we had the real true scale to support it, it wouldn't make sense to be vertically integrated. But because we own most of our deals just right in Houston, being vertically integrated is really great. We can be more nimble. We have more transparency. There's just less layers involved from us to the property. And the other thing that is important, not to everybody, but to many investors, it's a really important selling point. We work with private equity firms and family offices that, to them, that's really important in having that as a partner.
Okay. Yeah, and I completely agree with you. I think there is a benefit, but then, as you said, if you create a great relationship with a third party property manager, they can do all the things that your own property management team could do. There's certain efficiencies of having your own team, but it's not a necessity. So just kind of a last bonus question. I know that you are focusing on institutional investors. I think you mentioned you also have retail investors. Are you pivoting from one or the other? What's the benefits of going institution versus just a retail investor?
Yeah, for us, we think both are really great and really important, and they serve different purposes. So it allows us to be more nimble and approach different deals. Because if I have a $100 million deal tomorrow, maybe it's possible, but it's going to be a really hard time finding the equity through just only retail channels. But if I can go to a family office and get a $20 million check there, and then maybe syndicate some equity here and bring on some partners there, I can put it together. So having the diversity in our investor base allows us to pursue different types of deals, different sizes of deals, move at different speeds. Maybe we have an opportunity where the seller needs us to close really fast, and maybe that requires us to work with a certain capital source. So for us, the way I look at it is there's a lot of groups out there that just focus on one. They get really good at the retail investor game, or they get really good at institutional capital. Our vision is to be able to service investors all across the board and be able to raise, capital all across the spectrum. So we're not necessarily pivoting, but we're just trying to grow and optimize. And I think one thing that is valuable about the institutional side is it really trains you to be top notch in everything you do, as far as your communications, your reporting, your operations. And then we take what we've learned from that approach on the institutional side, and we bring it to the retail side. So we treat everyone the same. We don't water things down or dumb things down for our retail investors. We give them exactly what we give our other partners. And some investors don't care, some don't even want that much information. But I think a lot of the investors that we attract specifically really appreciate that.
Excellent. Well, thanks, Rob. I appreciate all your insights there, and we're jumping to some questions now. So if you guys have questions, please put them in the chat box, and we'll try to get to them as much as we can. I know Rob has a sort of a cutoff in time, so Rob, if you need to leave, just let us know. But I'll go ahead and start with the first from Sia. Great insight as always. Thanks, Rob. Regarding exit cap rates, what is your rule of thumb per year of hold? 10 bips increase per year, 15, or is it market specific for you? Maybe that's the first question.
Yeah, it's not necessarily market specific. It's more, it could be market specific, but we're just not in so many different markets where it makes sense to have different logic there. But it's for us, it's more deal specific. You could say if we are really bullish about a certain location, we just think this deal is in an amazing location in a market, or we think the property is newer, so it's going to hold up better over time and present less risks over the hold period, then you could justify a lower exit cap rate for those reasons. For us, I would say we're about 50, more so 75 basis points increase over our hold period. But we don't really do it on a per year basis because we'll do the same increase, whether it's a 3-year hold, 5-year hold, or we don't really project longer holds than 5 years. But that's how we do it. So it's yeah.
And then along those lines, your thoughts on projecting exit cap rate below 5%, irrespective of your entry cap.
Yeah, I think your entry cap, I know your entry cap is irrelevant to your exit cap calculation, because I always just say the example, if you buy a deal that's half empty at a 1 cap, that doesn't mean that the market's a 1 cap and that you should sell it for a 2.5 cap on exit. It just makes no sense. It has no bearing on your exit. What matters is the market cap rate today of what you're trying to sell. So if your goal is to sell a stabilized asset tomorrow, or 5 years from now, then you need to identify what is a stabilized asset selling for today, not what you're buying, because what you're buying could have high vacancy, low rents, it could have deferred maintenance, it could have a loan assumption, all these different factors that affect all, idiosyncrasies that affect the going in cap rate on this particular deal and have no bearing on the market cap rate. So it's first identifying the market cap rate and then having your methodology of expansion, whether it's 10 basis points per year or just 50 bips flat. Everyone's got their own way. The real secret sauce, the hard part, is finding out what the market cap rate is. And that goes back to our deal flow analysis spreadsheet that we keep. Because we're looking at so many deals and deals and deals, we see enough cap rate transactions that we can say confidently, okay, yeah, the cap rate in this market is this.
Excellent. Next question from Shoba. Rob, do you have any recommendations for real estate YouTube channels, economists, or in general, any people or websites that we can regularly keep on top of all things multifamily?
Well, my YouTube channel is good. And there
you go.
Yep. But I'm not really an economist. I don't really talk about current events as much. I just kind of talk about whatever I'm going through or whatever is interesting to me at that time. But as far as economist type related stuff or economy type related stuff, I always recommend everybody to subscribe to the Pensford letter. So if you go to pensford.com, the guy that runs that company, JP, he puts out a weekly newsletter on Mondays, and he's really knowledgeable about interest rates and the economy. And it's a great way just to get your quick weekly update on all that stuff.
Okay. And Nathan also has some great references as well. And Nathan, if you could just put those in the chat, I can read those to everyone. And let us move on to the next question from Sia once again. What were some key factors that motivated your team to bring the property manager in-house instead of using a reputable property management team in your target market?
Yeah, it's consistency of team and the position, kind of the differentiating factor that it gives us, particularly for institutional investors. Like I mentioned before, we know we work with private equity funds that they have a rule. They will just not partner with a sponsor if they're not vertically integrated. Just a rule. It's their rule. It's not the market's rule. But in the institutional space, you'll find that that's not terribly uncommon for it to be not necessarily a rule, but desirable. So that, we early on resonated with that and wanted to make that happen. But the consistency of team, as I mentioned, is that fact that at least in our eyes, we feel that we can better control the operations and the employee turnover if it's our own stuff.
Okay, excellent. And a question from Madhu. What factors makes an institutional investor want to work with you? You just mentioned being vertically integrated, but anything else?
Yeah, I think it's pretty similar as what any investor would want to work with. Why any investor would want to work with you would be reputation, track record, operations. They like sponsors that focus. The way that they look at it is they want their sponsor to add value to them, because institutional investors have access to so many deals, so many sponsors. They want to know they could do that deal with anybody. So why are you the right sponsor to do that deal with? And if you can show them that, hey, we're the market expert, we own a bunch of deals in this area, And that's why you're their value added partner. That makes a big difference. And like everybody else, they like communication, consistency, do what you say you're going to do, under promise, over deliver. It just takes time. It's 100 chicken dinners versus one lobster dinner. It's you can't build these relationships overnight.
Okay, great. Yeah, great insight there. And then, from our own personal experience, we've also found that, just your level of experience is extremely important. And then also, institutional partners require a certain type of return that the retail partners or individual investors don't necessarily want. They will expect a certain amount upfront, potentially, maybe more so, maybe more of a higher pref than a retail investor may want. They may want some additional back end money. So there's some give and take there. I mean, you're getting a big check, but you're maybe giving up some control as well. So those are things to consider. So Nathan put some different sites in the chats. Multifamilyhousingnews.com, Rob's YouTube channel. Also, Greg Dickerson has a great YouTube channel, and Marcus and Millchap is great. As a great reference. CBRE, Walker Dunlop, Newmark, Cushman Wakefield. They have all these various reports that are great references. I really enjoy Marcus and Millchap's reviews. They're excellent. They're all free, and anybody could kind of look and see what they've been, what the previous ones have been. So a lot of references there for you folks, and that's about it. That takes us to the end. Well, thanks, Rob. I appreciate your help and input here in educating our investors and all of us, and wish you all the success.
Yeah, thanks so much. It was great.
Thanks for listening to the Viking Wealth Show, the show that inspires you to feel knowledgeable, courageous, and skilled in your passive real estate investing decisions. Join our Viking Investor Club on our website, vikingmultifamily.com, to gain access to our amazing investment opportunities. Make sure to also subscribe and leave a comment for what you would like to see in our future episodes.